All right. So, anyways, here's a little message to YouTube. QuantBox has a massive amount of macroeconomic data. Okay. Massive amounts. We pull it from, mostly governmental websites like the central banks themselves. Okay. And we gather that data and then we organize it and then we do comparative analysis between, let's say, euro and dollar, euro and pound, euro and kiwi, and all that kind of stuff. Then we track things like 20 years of seasonality. We do statistical analysis, what you might deem as technical analysis. We look at the stock of institutional investors, meaning how much gold does hedge funds own, or do hedge funds own? How much Japanese yen do hedge funds own, and are they long or are they short? And then we track the week over week flow. See, that's capital stock and capital flow. Did they buy more this week or are they selling this week? Okay. This is the stuff we pull right out of the central banks themselves, and it's their projections and forecasts for both inflation and interest rates 18 months into the future. We also look at real time stuff. So, like market sentiment, we look at multiple markets to on multiple time frames, look for the correlation amongst them to uncover the underlying intrinsic trend. It's really quite insane, the amount of information. It's only $80 a month. 10 years ago, if you were a hedge fund manager and you were managing money and you had a team, to get this kind of research, you would have to hire a quant. Let's say $200,000 a year. 200, right? Um, that's what, so I would argue this $80 a month provides $200,000 worth of value. And a process of looking at this changes the process that would normally take, let's say, an hour, now takes 2 seconds. So it's really truly that powerful. So if you're watching this on YouTube, why don't you give it a try? $8. There's a free training course in there and everything. It's really, really good. Anyways, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. And I want to look at, I want to double check that I organized this. Oh, I did. So I organized this April 9th, April 8th. Oh, April 10th. Okay. Well, slightly out of order, but I pulled March out of there. So now you can find the recordings much more easily. Cool. Nice. Let's get on with it. Go into the QB Pro. Oh, I hope you noticed. Hope you noticed. I'm ready for the Masters today. I even got the ball marker. See, I was there 2022. Today is first day of the Masters. And just like 2022, we got rain. We got some rain. Hey, it's spring, bro. That it happens from time to time. Anyways, let's get on with it. We have way too much inflation. Headline inflation was very, very high. Really, all measures are much too high inflation. The market is pricing out interest rate cuts more. Now we're thinking maybe none, one or none, maybe December only. It's it's plausible. I'm telling you. So remember back in January, it was 6. And now we have it down to 3. And the Fed just reaffirmed 3. But the market's like, dude, not with this kind of inflation. Even super core inflation was high. So the world's like taking that, right? So remember, as this rises, it shows that the treasury market is falling. And so when you want it, when rates are coming down, that means you want to buy it. I bought this at 5.0 or 4.99, and it dropped to like 3 3/4, and now is rip roaring back. And it makes sense why. There's no like there's not a problem here. It makes sense. I mean, the issue is I might have to bail on this if we're not going to cut till December. This is going to go back to 5.0. So I have to choose. Do I just sit on it like Mother Goose and wait till 2025? Or maybe I can go to cash, do something with the cash as a hedge, wait for this to go to 5.0 and then buy it back. It's not an easy decision. I don't know. I don't know. I don't know. Remember, I'm a buyer on oil. Okay. I like I like oil. It's one of the reasons why we have inflation. And by the way, I hope you appreciated that yesterday after our meeting at QuantBox, I wrote an email and sent it to thousands of Forex traders saying, hey, I think the CPI is going to come out hot and that we're going to have risk off. And the reason for it is gasoline prices are going to go high. And then people logged into the myforex.today YouTube live stream, and I'm like, let me tell you why. Let's go into the EIA database. Here's the table in gasoline prices month over month over month. Look, they're going up. I think headline inflation is going to be high. We're going to have risk off, which is dollar strong. And then the news came out high, and the stock market dropped, and the dollar got strong. And I'm like, and you get that kind of fundamentals from like QuantBox. But isn't it nice to be able to send out an email an hour in advance and then a half an hour in advance, go through the process of explaining why? It's just fundamental data. And then boom, it's nice to be right. Cool though, right? That's the power of fundamentals. I would say sending an email with a prediction, and I did explain why I had that prediction, but to send it out to thousands of people, well, I think that counts as sticking your neck out. So, anyways, thank you, fundamental analysis. Thank you, QuantBox. S&P 500 coming down. Okay, yeah. I exited part of my stock portfolio, and I exited an exposure to Nasdaq. Even though Nasdaq hasn't fallen as much, I do believe it's got the biggest beta, and I got to be most careful on that. And then the most of the exposure is to into different portfolios of S&P 500, now a little bit of Dow. So I scaled out the highest one, and therefore, if I was going to hedge, I would hedge S&P 500 because that's where it's got a modest beta, but that's my biggest exposure. So if this falls, if I'm hedged, I'm okay. But in a weird way, it is a hedge versus like NASDAQ. And finally, for the first time in 8 weeks, we broke below 108. Okay. Bitcoin up a bit. Bitcoin up a bit. Okay. It's pretty good. It was remember yesterday it was 68,000. Yeah. So I got a couple of texts overnight from QuantBox because I am a subscriber to the QuantBox AI alerts. And let me check my text messages. Oh, here's one from President Biden. This one's Donald Trump. This one's here it is, QuantBox. This one came out at 3 o'clock in the morning, which is the London Open. If you look at my screen, it's beautiful. I know it's all blur. That's how it goes. But you see, USD CAD, it's telling me about CAD and why it changed, right? This is a message. Boom. Quantbox.co is not advice. New alert. Strong, bullish USD CAD, went from a 9 to a 10. Anyway, it's cool, right? Isn't that nice? Another one came out at 2 a.m. It's all right. I have it on do not disturb mode, but there it is, quantbox.co, price alert, strong, bullish, oil. Okay, cool, right? Breakdown, and it tells you retail sentiment, blah, 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 blah. Right? Cool. Isn't that nice? So now you don't even need to be logged into QuantBox. And you don't need to be paying attention. It slaps you in the face and says, hey, Timbo, get on the oil. Give me some oil. Yeah, USD CAD and oil. Noise. That's nice, right? Yeah, but it costs like 89 cents a day. Well, forget it then. If it saves you an hour, it's not worth 89 cents. Well, maybe to some it is. It's loading. Cool ball marker, huh? Master. No, it'll just never focus on anything, huh? Cool, huh? Still not loading. Whoa, come on, bro. Well, maybe that part of the database is hung up. Let's take a look. Let's do the scatter plot then. Bitcoin way up. Remember yesterday? I'm like, now's the time. I sent out my invoice to one of my clients. I'm like, pay me today, pay me today, pay me today. When it was 68. And they didn't pay it. Shoot. And now it's 70, 71. And I'm like, oh man. So it's a good to be a trader and investor when you know how to time these things. Like most companies wouldn't know, like when do you send an invoice in crypto and when not to send the invoice in crypto. So, anyways, too bad, so sad. I mean, hey, you pick up a couple of extra percent, it adds up at the end of the year, right? So, anyways, crypto bullish. You missed it yesterday. Shoulda, coulda, woulda. Whatever. I mean, we definitely, absolutely, totally discussed that. All right. Now what? So, hot inflation, that's risk off. And Dow is down, S&P 500 is down, DAX is down, NASDAQ is down, oil is down. So maybe that's a buy of the dip. We'll find out. And I don't believe it's down because of the news. I think the news came out and the markets are down because this has been so high. Japanese stock market is down. British stock market is down. Everybody's down, bro. That's exactly what you would expect. So you should be at least taking advantage of potentially risk off and short selling or hedging. Or like one of my first moves, like I said, on that NASDAQ exposure, So I looked at the S&P 500 and I looked at the fundamentals, and I saw that we definitely are technically and fundamentally in a situation where bearishness may be the theme for a while. So then I make the leap of faith saying, well, my riskiest exposure to the stock market in a scenario like that is NASDAQ. So all I did on that was go to cash. I was very profitable on that. I think I had bought it in November, and here it is in April. It was way up, but it was most vulnerable to the downside. It goes up the most, but it also comes down the most. And that's what we call beta. So I just simply went to cash. And now I could just take the cash and put it in the money market, and those 2-year notes are going to still pay you 5%. So you could go to cash, remove the biggest risk, and then sit on it on 2-year treasuries and earning 5%. It's not bad. Okay. There was a time many, many years ago when PayPal was it PayPal? I think it was PayPal. PayPal was had a money market program. This was back when I lived in California. So I don't know what year that was, but the Fed funds rate was 5.25, and the money market, and couldn't tell you what the money market was back then because I didn't really understand it, but um, PayPal was paying 5% to have money in your PayPal account. So I had like $300,000 in cash sitting in my PayPal account, and it was, I mean, it had significant income. It was like, holy smokes. It was pretty amazing. And then you have to pay your taxes. Oh, but anyways, let's see if we can get these risk gauges going. So all I'm saying is, look, if you park some money into that money market fund while you sit and wait for this pullback to ease, and I think it could last 6 months. So you could just take 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 some profit on your good investments that you've made over the last 6 months, rotate that into no risk, income positions while you wait. So now you have less risk. Meanwhile, the income you're earning is a hedge versus the losses you would have had, or the losses you're getting out of things that you can't, take profit on. And then you take that and then you buy back in at the bottom, which is traditionally, end of September, but this year could be middle of November. So, you might have 6 months or more where you just sit on that and earn the 5 with no risk. Oh, that's good, right? Things to think about. Well, this is all the things you should be thinking about right now because of yesterday. Now, you're like, well, Wayne, how do you get to that conclusion? Well, luckily we have QuantBox. Okay. So looking at our monthly and weekly evaluations, we both have scores of -3, which is risk off. And in this situation, you would expect to buy dollar, yen, and Swiss franc. Now, Japan has a policy situation going on right now that might get in the way of that, but it doesn't change the model of what's normal. Swiss franc is actually cutting interest rates, which weakens the currency. Okay. Okay. So we got to put that in our analysis. But normally you would look for, in a risk off scenario, you would look to buy Swiss franc. And then, of course, dollar is obvious. And that one doesn't have any problems. The central bank's not getting in the way, but the BOJ and the SNB are. So the cleanest one right now is dollar, but who knows? Who knows what you might find over the next coming days and weeks with these other ones. But Quantbox is very clear. In this situation, these are the things you would normally look to buy, and these are the things you'd normally look to sell, like sell S&P 500. Okay. Sell Kiwi, sell CAD, sell Euro. You got to, but not just blindly. Now you got to do some technical analysis and say, well, you don't have a problem selling Euro No, you don't have a problem selling Kiwi, but you might have a problem selling euro because maybe euro is stronger relative to the others. It's just sort of heads up. And also gold, you have to think through this. Normally, in a situation, you'd have a reduction in aggregate demand. Okay, but if you take it one step further, why are we in a risk-off situation? Well, because we have higher than expected inflation. Well, that's when you buy gold. Now, I can't keep tweaking the model every time something happens so I can get what I want. Then you don't need a model. You just have to understand what the model's doing and the inputs into the model and say, well, okay, normally you might buy gold. But in this case, I mean sell gold, bearish, right? But in this case, we might want to be bullish. So you still have to understand what's going on. Okay. Unless, because with the high inflation, that is a time to hedge with gold. Or maybe the new gold, what we call Bitcoin. The two things that they have in common, or the thing they have in common amongst those assets, gold and Bitcoin, is that gold was made inside of a exploding star. Gold does not come from Earth. And there is a certain maximum finite amount of gold on Earth. We don't know how much is in the ground. Much of the gold we do know that's still in the ground would cost $5,000 per ounce to dig out, and it's only worth 2,000. So it's sitting there, and we haven't mined it yet. Well, in a similar way, Bitcoin, there's a finite amount. There's more that can show up in the future, but it's yet to be mined. But at one day, even that stops, right? So there's a finite supply and there's a certain use case. So you could say, well, to buy an ingot of gold, so ingots are small, not bars are big, right? An ingot of gold, I don't know what they cost. Let's say they're 40 grand or something. Um, then you got to store it, especially like if you only have one ingot, maybe you're like, I'm not going to store it. If you have 10 ingots, you're like, I need to store it in a vault with security. And now there's a cost to that. Okay. There's a cost to that. We call that a carrying cost. So every month you pay the bill to have it stored. And so every month you're losing money, right? So, anyways, Burns says, we don't know the max supply. No, we know how much there is, right, Burned? So we know how much there is. And because gold has always been valuable, we've always written down. Some of the first use of written word came were two things: mapping the ebb and flow of the tide of the Nile. We wrote that down. The Egyptians wrote that down. And then when we got to maybe even a little bit later in history, like the Sumerians, in what we would now say Basra, um, they started writing down like gold. In fact, um, not so the Sumerians invented fractional reserve banking and gold deposits and all that kind of stuff. Pretty interesting. But we do know how much there is. It's not you can't just make more, right? Okay, that's the point. You can't just decide to make a whole bunch more, right? So there, right, and that kind of stuff. So, so it doesn't matter. It's close to finite, and well, there is finite. We like at some point, there's only so much gold on Earth. The rest is just out in the universe, right? Again, gold is not even from Earth. Gold is from the inside of an exploding star. It's a non-earthly element. So, anyways, you all I'm saying is it might be cheaper to own Bitcoin than gold, and so maybe maybe that's something that you would want to look at. look at. All right, so we got a morning. We got the ECB. Let me load it. By the way, it makes me so happy, the new calendar. It's so simple. It's so basic. It's kind of ugly, kind of like those little dogs that people have. They're stupid little yappy dogs and they're ugly. And you're like, but they're so cute though. Right? They're so ugly, they're cute. That's kind of like this quant box calendar. It's so simple, but I like simple. Okay. And so we have ECB meeting today. Cool. Right on. Now, PPI is going to be interesting because it's measuring future inflation. And now we're hyper worried. And it measures things differently than CPI. I don't know if I can think of an example. Mm, no, but anyways, um, it might be different. It might come out quite different than what we saw in the CPI. Also, remember the Fed is going to push back on the concerns about CPI because they don't even use CPI. Right? They don't even use CPI. They use PCE, and PCE is significantly lower, like what, 1% lower? Okay, and then jobless claim. So, this period here, pre-market open, is going to be busy, and we're going to watch the ECB stuff. But this PPI, I mean, we might switch over to do PPI as well. Depends on what TRADARS, what the sonars tell us. The sonars will tell us if we even care about PPI, and that's what I like about that tool. If the sonar says there's no repeatable pattern, then you don't actually care. It'll create volatility, but if it's unpredictable, then it's irrelevant. Okay, what do you think? Change in direction since yesterday? Yeah, huh? It's helpful, isn't it? Now it looks like you should be shorting rallies. If it comes up to 108, maybe you take it down. It's not a big change down, but we haven't been this low for, well, a little bit in the bottom of April. Okay. But it's been in the 108, from 108 to 109 for a long time. And now we have a new lower low and we're below the moving average, bearish, not neutral. Oil. We talked about this yesterday. Maybe buying a dip is the play. Very bullish. Rand. Do, 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 do. I have to double check if that's right. That doesn't look bullish. Maybe it is bullish. I don't know. Huh. I have to look at that. I'm wondering if this chart is not correct, but the prices seem to be right. Huh. I'll have to double check that one. USD yen. This was a big move, huh? We talked about it, talked about moving. Yeah, now we have a projection of 154 in the next week. Looks like maybe a buy a dip scenario. This is the average price, by the way. And, it's just there because I can put it. So the average price right now is 152.30. Joseph, it doesn't incorporate the FedWatch tool. Okay. Switzerland trying to weaken their currency, and we have that dollar strength. We went from 90 to 91. Quant Box is saying maybe consider buying dips. Okay. Dollar got strong versus the Canadian dollar. And Joseph, on that comment, I don't know if we can even pull that data out of their database. I don't know if they sell or offer an API on that. But that's how QuantBox works, where we would have to be able to drill into their database and pull the data right out of their database. Um, all right, going to the Dow, it had the biggest move when we got near 40,000 and it dropped to 38 and a half. And with yesterday's news, it says, well, seriously consider selling rallies. You sell the rip. Okay. Take a look at the British stock market. Oh, it's interesting. It's hanging in there. It's hanging in there, which is interesting. So this is not a reflection of the technical trend. This is a reflection of everything. This comes from the scorecard summary. So it's bearish, but it's going up, which is interesting because the way you could be playing that is looking for something like that technically and then get short. Okay. So again, this is the economic score. It's not only looking at technical analysis. This is just a reminder that statistical analysis of this price time data set shows that there is a positive integer in the slope of the average. This the the average price over time is going up. And then there's the standard deviation. Okay, great. But it's a bearish asset quantitatively. So think of it this way: if or when this starts to slope down, you can engage as a bear. It's really good information to have that. Okay. Quant Box is saying, hey, if it gets to 152, sell it. Okay. Right now, the bearish target is 51. Okay. So the way that it's displaying is like, okay, we're here now. So if it goes up, sell it. Okay. Or some variant of that. I mean, it's not doing technical analysis, it's doing statistical analysis, but that's how you would interpret that. And so you're going to kick it off the daily 21. Okay. Kick it off the daily 21. So you go to your charts and you then look for better, or you conduct better technical analysis. Remember, QuantBox is only doing fundamental and statistical analysis. If you want some technical analysis, use TRADARS.co. It does fantastic. So you could go here and say you're bearish on the FTSE, and then use TRADARS, and you sit and you wait for bearish trade plans to be developed by TRADARS, which is your signal to go. TRADARS doesn't do any fundamentals. It doesn't know what should be. So if the pattern says up, it says up. It'd be better if you were, you'd likely do better if you said, well, I'm a bear on FTSE, but it's going up. And then you go to TRADARS and it shows you bullish trade plans. Why? Well, look, it's doing technical analysis. And you're like, yeah, but I'm not a bull, I'm a bear. So you ignore it. And then suddenly this changes direction for whatever reason. Fundamentally, you're still a bear, but now it's giving you bearish trade plans. You're like, oh, those are the ones I want. I think if you do that, you're going to do brilliantly. German stock market, definitely bearish. Sell the rip. Okay. Japanese stock market, definitely bearish. This was the most bullish asset. Do you guys remember? For months and months and months, this was the most bullish asset. It went from very bullish to neutral. Now it's bearish. Are you on the clue train? Oh my gosh, right? Okay. When you analyze euro versus dollar when it comes to inflation, okay, we're at 3.5 now. Europe is at 2.4. Okay. This means euro, when you look at this and you look at this, they say euro dollar would fall. If you want to compare, okay. I think I need to probably, yeah, see, it's in the wrong color. See, dollar euro. So I think I can change that myself. So when you compare, so euro is blue. Oops. Okay. Euro is blue. So high inflation, higher than the US, 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 less than the US, less than the US, less than the US, less, less, less. These things add up to euro dollar should fall. Euro dollar should rise. Euro dollar should fall. Okay. Okay. Here's current inflation in Europe. There's the old inflation in Europe. Here's the old inflation in the United States. Here's the new inflation in the United States going up. That's bad. Okay. Falling, right? Falling inflation in Europe is good. That's why it's green. Cool, right? Okay, Burns, your question had to do with the price forecast, right? Okay. Okay. Again, this bearishness is the totality of our macroeconomic analysis for the Japanese stock market. It's not price and time data. This is one of 9 components of the analysis. So how long? There's no time component. As long as the economic situation in Japan remains the same, then the economic forecast remains the same. So For this to change, you need the economic conditions to change, with the idea that the monetary policy will change and so on and so forth. But there's no time component to the analysis. Now, when you do this chart, we have price and we have time, but that's one component. So again, I'll make this point. This comes from this. Okay. So 1, -1, -2, -2, 0, -1, 0, -1. It's looking at COT, retail, seasonality. There's the trend from the price forecast. GDP, inflation, labor market, and interest rate differentials. Yeah, cool, right? So, yeah, so it's cool. I think it's really cool. I mean, it's really hardcore information, like, right? The more you get into it, it's pretty amazing stuff. So when you look at inflation in the United States and you're looking at the S&P 500, here's the inflation going up year over year. Core remained the same. Okay. Both are not good for the stock market. So the stock market comes down. Oh, look, they got the color right on this one. Okay. Inflation going up, that's bad. Inflation staying the same, well, okay. I don't even know if Bitcoin should be on this list. I don't know if we can do it. This is a stock indices, right? Yeah, so it shouldn't even be on there. That's a bug. It wouldn't be able to analyze it. Yeah, this shouldn't be a complete list. It should only be stock indices because this isn't doing comparative analysis. It's only looking at the one. And that's funny. The other ones are not even here. Um, yeah. All right. Cool. I found a bug. That shouldn't be right. CPI year over year is going up from 3.2 to 3.5, and that would be good for gold. Month over month, nothing happened. There's right, not good for gold. Okay. Now you could argue one way or another, this is just doing calculations for you, right? But anyways, I don't like month over month. So I would, if I were me, I would just use this. Maybe I'll kill everything else. Maybe I'll just do what I want. Excuse me. But when it comes to gold, inflation is above the Fed's target and rising higher, you would buy gold. This does fit my personal model. Okay. What do you think? And this table is proper. All right, so I have some feedback I need to give them. Cool, right? I hope you're playing with some of these tools. So maybe oil is a buy a dip day. Oops, let me close this. Maybe oil is a right. We buy a dip, so you might want to look at commodities. Okay. Oh, here it is. Okay. And let's try to analyze this. Remember, why is oil coming down? Is it the end of the fundamental trend? Well, the projected high for the month of April using technical analysis is between 86 and a half and 88, which we did, and now it's coming down. So I would say on the daily chart or the 4-hour chart, you decide to buy a dip if you're a bull. Fundamentally, according to QuantBox, you have permission to consider it. Now, maybe you're not so good at technical analysis, so let's go back and do some statistical analysis and say, okay, QuantBox, please help me find a decent price to consider buying oil. So QuantBox will help you statistically. Remember, it's not an opinion, it's just statistically. 83 and a half, and somewhere between 83 and a half and 85 and a half. 83 and a half to 85 and a half. Using the mean, linear projection of the mean, and one standard deviation below the linear mean. Okay. 83 and a half is about here. Oh, we've already done it. Okay. And what was the other one? I think it was $2, 83 and a half and 85 and a half. Is that right? 85 and a half is right there. Cool. Go into a 15-minute chart. And I'm in the business of buying if I get the opportunity. Remember, we're doing technical analysis now. We're done with the fundamentals. Okay. So you say plan A buy WTI on upward reversal. Okay. Okay. And then we go to plan B. Lovely. All right. Plan B. Oh, behave. All right. There, I'm done planning for the day. Somewhere around here, if let's say even on a 5-minute chart, I analyze this technically and see that on a 5-minute chart it becomes bullish, I buy it. I buy it on the statistical mean with a positive integer and slope. I buy it there with a projection up here. Okay, great. If it falls further, I'm okay. Because even if it crosses up, I'll just lose a little bit of money. If it never crosses up and it just falls, well, I'm not in it anyways. If you're using technical analysis, more often than not, when you're wrong, you don't get a trading opportunity. So you're just sitting on the sidelines, whistling Dixie. So then you're like, oh, well, I guess I'll let it fall. So that means it's down for $3. That's a very big down day. So you're most likely setting up tomorrow's trade. But you might end up taking it today, but it's based on tomorrow. So maybe use daily pivots or something. But whatever. If it comes down here, then you sit and you wait and you sit and you wait. So let me try to draw out a scenario, right? So it does this, it does this, it does this. Do you buy it? No, that's not a reversal. And then it does this. Now do you buy it? It's still not a reversal. Then it does this. Well, you never got in it. What? And now it does this. Do you buy it now? No. What about now? Yes. Okay. Or use your technical brain and say, I understand what QuantBox is doing. It's doing nothing but fundamental analysis. It doesn't know anything about technicals. It doesn't know reversal patterns. It doesn't know pivot points. It doesn't know anything. This is statistical analysis of a data set. So you say, well, I get that, but I don't want to be a bull. It's very bullish, but I don't want to be a bull here or here or here. But at some point in the future, and it could be next week, maybe you become a bull again. That's how you're supposed to be doing this. So I just did a whole bunch of hardcore technical analysis. And I'd say one of these three black lines that I just drew will be your price if this is going to go bullish again. Which one? Well, I don't know. That's your job as a technician. On the flip side, TRADARS might give you a WTI pattern, but it doesn't know anything about fundamentals. It doesn't know why it's going up. It's just telling you it is going up. And then it might tell you it is not going up. So again, if TRADARS says oil's falling, you could sell it. It doesn't know why or how long. It just knows that it is falling. But you might say, oh, oil is falling now, but I'm very bullish. Right? So you wait, and traders doing nothing but technical analysis might see this and then start to see this. Well, I think the best way to use these two tools in conjunction with each other is you stay very bullish and you wait for this to engage. Right? Yeah. You see, this is what I'm pushing. This is how you're supposed to be doing this. If you're the boss at your hedge fund, you're the portfolio manager overseeing the actual trades. You don't take orders from your quant, and you don't take orders from your technical analyst. Okay? Your technical analyst has a bachelor's degree. Your quantitative analyst has a master's degree, but you're a boss. So you pay one $100,000 a year. You pay the other $200,000 a year, but you make $1 million a year because you make the big decisions. How to use this information that your team is providing to you, which means if you have QuantBox and TRADARS, it's worth at least $300,000 a year. Or you're not doing it right. Cool. So that's that. We're done. What a wonderful day. We got ECB coming up in about 45 minutes. So I'll see you over at Forex today. Maybe they cut. Maybe they cut. Maybe they cut. Could be interesting. Peace on earth. May the pips be with you. May your profits be above average. And may the rain in Georgia go away so we can get some good golf in, huh? Master. Master. I'll see you soon. Stay beautiful. Cheers. Or is it stay classy, San Diego? Cheers.